All right, in this explainer, we're going to tackle the language of business finance. And trust me, by the end of this, you'll get the hang of all those key terms companies use when they talk about money.
So, have you ever wondered how a business actually gets started? How it's born and how it learns to speak the language of money. Well, to figure that out, we're going to follow the story of a brand new company. It's a great way to learn the basic financial terms every business uses, right from the very beginning.
Okay, first things first. What does any new company need to get off the ground? Money, right? And in the world of business, this starting money has a special name: capital. Yeah, think of capital as, like, the seed money. It's the fuel you need to turn a brilliant idea into a real, actual business that's up and running.
So how does a company get this capital? Well, there are basically two main paths it can take. It can either sell off little pieces of the company itself, or it can just borrow the money with a promise to pay it back later.
Let's dig into that first option, selling ownership. When a company sells something called shares, it's literally selling tiny slices of itself. So when you buy a share, you're not just handing over cash. Nope, you're actually becoming a part owner of that business. Pretty cool, right?
And what about the people who buy these shares? Well, they get a name too: shareholders. Since they've invested their own money, they're now part owners, and they really have a stake in seeing the company succeed.
Okay, so that was path number one. What about path number two? That's taking a loan. This is exactly what it sounds like. The company borrows money, usually from a bank or maybe some investors. It's kind of like getting a cash advance that you have to pay back down the line. But, a loan isn't free money. There's a catch. That extra bit you have to pay back on top of the original amount you borrowed, that's called interest. It's basically the fee you're paying for the privilege of using someone else's money for a while.
Okay, so the company's up and running. Now we get to the really important part: keeping track of everything. We need a simple way to see what the company has versus what it owes. And this is absolutely fundamental to figuring out if the business is healthy.
It really all comes down to a simple balancing act. On one side, you have assets. That's the fancy word for all the stuff the company owns. And on the other side, you have liabilities. That's the word for everything it owes to other people. Keeping these two in balance, well, that's the secret to a healthy company. So, what are assets exactly? They're all the valuable things the business owns and controls. We're talking about the physical stuff like buildings, cars, maybe some furniture, but it also includes the money it has sitting in the bank.
And on the flip side, you've got liabilities. These are all the company's financial promises or debts. This includes things like paying back those bank loans we mentioned earlier, or maybe paying a supplier for materials that they delivered but haven't been paid for just yet.
Okay, here's another key term for you: working capital. Think of this like the company's wallet or its checking account. It's the money it has on hand, ready to spend on all the everyday expenses. Things like paying salaries or buying office supplies. So with all this activity, money coming in, money going out, how in the world does a company actually know if it's winning, if it's successful? Well, that brings us to the most important question of all: is it making a profit? And finding that out is actually a pretty simple formula. First, you start with revenue. That's all the money coming in from selling things. Then you subtract all your costs and expenses, stuff like rent, materials, and paying your employees. And what's left over at the end? That, my friends, is the profit.
But what happens to that profit? It doesn't just get stuffed under a mattress. As you can see here, that profit gets sliced up, usually into three main pieces.
All right, slice number one. A piece of that profit has to go to the government. No getting around it. That, of course, is the company's tax.
Okay, next up. The company can decide to give a slice of the profit back to its owners, the shareholders. It's like a thank you for their investment. And this payment is called a dividend.
And finally, after taxes are paid and dividends are handed out, whatever is left over is called retained earnings. This is the money the company keeps for itself. It's what they use to grow, to reinvest in new projects, and to build for the future.
Okay, let's bring this all home. In our final section, we're going to see how all these pieces, the assets, the liabilities, the revenue, the profit, are all put together to tell the company's complete financial story.
And this story is told using a few official documents called financial statements. The easiest way to think about these is like a company's report card. They give everyone a really clear snapshot of its financial health.
Now, there are two big ones you really need to know. First is the balance sheet. Think of this like a photo, a snapshot in time. It shows you exactly what a company owns and owes on one specific day. The other one is the profit and loss account. This is more like a movie.
It shows you how the company did over a period of time, like a whole year, and tells you whether it actually made money or not.
And that's it. You've got it. You now know the basic language of business finance, from capital all the way to retained earnings. Every single company out there has a story to tell, and now you actually know how to read it. So which one will you look into first?